Paycom has been a home run investment for its long-term shareholders. The stock is up more than 2,000% since it came public in 2014. But right now, shares are down more than 40% from their all-time high. So we think right now is a great time to add shares of this compounding machine to our public portfolio. Why? Here's everything you need to know about investing in Paycom today. Thanks to Common Stock for sponsoring today's video. As of the time of this recording, I am a shareholder of Paycom.
And I am a shareholder as well. So let's talk a little bit about Paycom. This is a $20 billion business that trades under the ticker PAYC.
Paycom's mission is to connect employees with their personal data. This is simple and optional. It's not very inspirational, so we think this is an okay mission statement.
Paycom is a software as a service company. It started by focusing on payroll, but has expanded to include all the functions of a human resources department. Users can have one app where they can access everything from talent acquisition to payroll to HR management and time and labor management.
There's a lot of competition in its industry, so one thing that Paycom has done to separate itself from its competitors is by focusing on small and medium-sized businesses. The company boasts a gross retention rate over 93%. That's quite attractive given that this company primarily targets small and medium-sized businesses historically.
Customer acquisition costs have been surprisingly low, eating up less than 30% of Paycom's gross profit. Demand has been robust since it came public, and nearly all of the revenue is recurring in nature.
Turning to the moat, we don't think that Paycom benefits from the network effect at all, but we do think that it does have switching costs working in its favor. Setting up a payroll processing company is an arduous process, and once a company gets on board, they are loath to switch to an alternative provider. That makes the fact that this company's revenue growth has been so strong over the years incredibly impressive.
We also want to call out the fact that with such low sales and marketing expenses, there is some brand value associated with Paycom within its niche. You add all these things together, and we believe that the moat is widening around Paycom.
Let's take a look at the company's financials, which are jaw-droppingly good. Revenue growth has been over 28% over the last 3 years. Gross margin is exceptionally high at nearly 85%, and this company consistently cranks out positive net income on a GAAP basis.
Much the same can be said for free cash flow, which has been positive and growing for a number of years. The balance sheet is in stellar shape, and Paycom does have solid returns on capital.
Paycom was founded by Chad Richardson, himself a salesperson in the payroll processing industry that decided to found his own business. He remains the president, CEO, and director of the company today.
And Richardson gets solid remarks from employees, garnering 4 stars on Glassdoor.com, and he makes up the bulk of insider ownership, which totals 15% of the company and is worth about $3 billion today.
So can the company's growth rates continue? We think the answer is yes, because the company benefits from a low level of optionality. Paycom got its start in payroll processing, but has since expanded into numerous HR functions. While many of them don't generate huge amounts of revenue, they do strengthen the company's moat over time.
Turning to operating leverage, this company is already spitting out a lot of cash. There is room to improve, but not as much as some other investments that we've made. The total addressable market is about $27 billion, of which it's captured 5%, and nearly all of the growth that Paycom has had has been organic in nature.
So how has Paycom done for shareholders so far? The answer is fantastic. This company is a 20-bagger since it came public in 2014, and it's also thumped the market's return over the last 5 years. The company also has an excellent track record with execution, having outperformed Wall Street's expectation on the bottom line in each of the last 4 quarters.
Paycom has been using some of its extra cash to buy back shares, but it is not paying down debt or offering a dividend as of yet.
Sounds good so far, right? Well, there are a number of important risks to keep in mind. The biggest risk by far is competition, as Paycom is squaring off against entrenched competition such as ADP, Paychex, and Workday. There's also a number of other upstart companies that are also getting into the payroll processing space, so competition is the number one risk for investors to watch.
Next, we believe that there are some outside forces that pose a threat to Paycom. Remember, this company is primarily focused on small and medium-sized businesses in the United States. Now, right now, the labor market is quite strong, but if it weakens, as some think it could in the year ahead, that would affect Paycom's business.
Finally, there's valuation risk, which we'll cover in just a little bit.
So how did Paycom do during its fiscal third quarter? The answer is great. Revenue grew 30%, coming in ahead of Wall Street's estimates and management's guidance.
It was a similar story on the bottom line, with earnings per share growing 38% on a non-GAAP basis, blasting past Wall Street's targets.
Look at the company's margins on a GAAP basis. Gross margins expanded slightly, but operating and net margins expanded meaningfully.
Free cash flow took a step backwards, but was still positive at $44 million. Net income expanded by more than $20 million, and the balance sheet remains in outstanding shape.
For the current current fourth quarter, management called for 29% growth on the top line, which was ahead of Wall Street's expectations. And while the company doesn't offer earnings per share guidance, Wall Street is expecting that number to grow by 34%.
For the full year, management is guiding for 30% top line growth to $1.37 billion. That's ahead of what Wall Street was expecting. And Wall Street is also expecting 33% growth on the bottom line.
So what should investors watch moving forward? Well, first, keep an eye on that top line growth.
Second, keep an eye on operating margins. The company has consistently grown its profits faster than revenue in the past. We want to see that trend continue.
Third, look for gross retention rates. This is a number that Paycom only releases at the end of every fiscal year, so you should be coming up when they release fourth quarter earnings.
And then finally, keep an eye on free cash flow and what the company does with that free cash flow. Historically, this company has returned value to shareholders through stock buybacks. We want to see that continue.
Overall, we definitely believe that the moat is at worst stable, at best expanding, and that the thesis for investing in this stock is very much on track.
How did Paycom score on our investing frameworks? The answer there is fantastic. Paycom got an 81 on my framework, which is well into my high quality business category.
And it got a 10.5 on my framework, which makes it very investable.
But how about the company's valuation today? Well, first, let's consider where the company is in its growth cycle. We think that the answer is somewhere between stage 3 and stage 4. The company is not fully optimized for profits, but it's getting close.
Because of that, it means that we can look at most of the items on the income statement and draw conclusions about valuation from it.
So let's take a look at the company's price to sales ratio, price to gross profit, price to earnings, and price to free cash flow ratios to see what kind of prices investors are paying today.
On a price to sales ratio, Paycom is trading for about 15 times sales. Now that is very expensive compared to the rest of the market, but it's moderate given the company's history.
On a price to gross profit basis, the company has generated about $1.1 billion in trailing 12-month gross profit. Divide that by the company's current market cap, and that gives us a figure of about 18. Again, high in absolute terms, but Paycom has deserved the premium historically.
Next, let's turn to free cash flow. Right now, Paycom is trading for 95 times trailing free cash flow. That is very high in absolute terms, but it is roughly in line with where the company has traded in the past.
On a price to earnings basis, the company is trading at about 75 times trailing earnings. That's very high in absolute terms, but again, this is a high quality business.
And if we look at the company's forward PE ratio, it's trading for about 54 times what's expected to earn over the next year. Again, that's very high relative to the rest of the market, but pretty low given the company's history and its operating performance.
So there you have it. Those are the reasons that we're going to be buying Paycom stock in our public portfolio that you can track by following us on Common Stock.
Click the link in the video notes below and you can leave a comment letting us know what you think about this purchase on Common Stock. We're going to read through those comments and choose the most insightful one. Whoever wins will get $100 from Common Stock.
We hope you found this video to be useful. Brian's out.